let's go to our first management. We have Amitabh Bhattacharya, CFO at Hariom Pipes, to talk to us about, of course, their fundraise, but as well as what the future growth outlook really looks like. Mr. Bhattacharya, first off, talk to us about the fundraise. How critical and where are you investing?
Yeah, good morning. Actually, on 2024, our board approved an enabling resolution for a qualified institutional placement of up to 700 crore. But as you are aware that as per the SEBI regulation and the insider trading norms, I am restricted from sharing further details at this moment. So it is already in public.
Got it, Mr. Bhattacharya. But in terms of rationale for the fundraise, could you give us some insight on what the fundraise will be allocated towards?
Yeah, in the appropriate time, we have to as you are aware that SEBI regulation at this moment, it is very difficult for me, that is insider trading norms, I have to disclose. In the correct time, the board will be decided and the board will place, and once they approved, we'll definitely disclose in the public domain. Just wait for a little bit time, it will be come out very soon.
Okay, sir. And just about with regard to how debt is shaping up, I'll focus in on the capital structure. We've got around 350 odd crore of debt on the balance sheet currently at the end of FY24. Does that at all change likely as part of this raise?
Again, it is related to that only, inside trading norms trigger. As per the growth from past 4-5 years, if you see the first 4-5 years CAGRs and revenue and everything, the company has grown like anything. So if you see that revenue CAGR is 54%, the ROC is last year 19%, and the company having the sufficient potential to reduce the debt by their own also within 2-3 years. And subsequently, the net debt to EBITDA will be coming down in a very good manner. Now, net debt to EBITDA is 0.8. It will be coming down very fast.
Got it, Mr. Bhattacharya. Let's shift your focus on capacity. Now, the company's has been committed to, increase the capacity. It's grown at a 30% CAGR in the last 5 years. What is the target in terms of capacity for the end of FY25? And could you give us some more details on what's in the pipeline or under construction right now?
See, by FY25, the maximum, whatever the capacity, Hariom expanding its capacity, a significant portion of their capital expenditure is already completed. Presently, our finished steel product capacity is 0.4 million tons, and overall gross capacity is 0.7 million tons. And we are targeting to achieve the optimum level of the utilization of the capacity by the end of FY26. That is already we have disclosed in our recent past investors meet in Mumbai also. So we have to target it, and the company is very much focused. After that, as the consistent growing trajectory, we have to expand it by way of brownfield model or satellite model, geographically, horizontally and vertically.
Does this involve also new products coming to the fore with regard to their contribution to revenue? Can you talk to us about some of those?
See, actually, we have introduced new product in earlier. We are an integrated steel player, totally raw material backed. Our raw material is also producing by us. That is our USP. After that, in current financial year and the last financial year, we have introduced new verticals, that is only galvanized and cold rolled verticals. And in Mahbubnagar plant, we have already added tandem mill, which can be produced 0.4 mm thickness of coil, which will be used for engineering sectors, automobile sectors, fan industries, and so on. So these are the value-added product which will be added recent past. So this will be coming future. It will be added the more value in our in revenue terms and in profitable terms also.
Mr. Bhattacharya, one of the new products that the company also introduced was GI pipes, which are galvanized iron pipes. And now this is a high margin area, I suppose. Could you give us more details in terms of, the growth potential via these products, and what kind of margins could the company see with this product itself?
See, Basically, presently in GI and GP, we are having the EBITDA, it's near to 7,200 something as per the last audited financial. And we are very much looking forward to get the EBITDA margin in GP and GI is subsequently more than that. And it is up to 8,000 we'll be able to reach in the coming years.
Okay. And so what kind of margin does this clock? Because you're likely in early teens in terms of margins at best on a full year basis.
Sorry, can you repeat about?
What kind of margins does this product category clock? Overall, just for viewer context, you're in early teens in terms of margins, if I'm not wrong.
Yeah, we are having good margin comparatively to others because our main USP is we have our own raw material, and that is why we are getting much more better margin. And our USP in terms of this also, the new product vertical also, we are expecting some around 12 to 13% EBITDA will be coming into the new vertical of the GP product also. It is coming in the coming future.
And so just overall on a blended basis, when I'm looking at your margins, there's a significant shift in product mix. Maybe say over the last 3 to 4 years towards more value-added products, but not seeing that shift in margins. Is that the correct way to look at it, or how should one, take stock of this?
No, actually, if you see that last 5 years margin, if you see the blended EBITDA, FY21, our blended EBITDA was 5,756, exactly to be precise. And here our contribution in the value-added product is less comparatively to the other steel products. Whereas if you see that in next year, FY22, our blended EBITDA is 8,938, where we have little bit shifted to, almost all 50% more shifted to the value-added product, and the margin is shoot up. And as you are aware that in FY22 also, the steel market, all the steel manufacturer players, that is the golden year for everyone. So we are also getting a very good margin comparatively to other financial year. In the next financial year, subsequently in FY23, it is coming down little bit of 7,500. But at the same time, our value-added product is growing much more contributed. And now in FY24, almost more than 90% we are contributed through value-added product. And subsequently, the market, if you see that price down in the comparatively to FY23 to FY24, there was a price correction almost all 25%. After that also, we have achieved 7,200 plus blended EBITDA margin. And in the coming future also, if you see that the government's investment budget and investment, government is very much focused to invest in infrastructure, railway. So therefore, the steel market or steel industries, whoever the players, are having bright future in coming 5 years for India. So therefore, we are very much keen and looking forward to get better margin in our financials.
Got it, Mr. Bhattacharya. Let's talk about your sales volume now. FY24, when you compare to FY23, saw an 82% growth. What kind of growth or sales volumes do you expect for FY25?
See, ma'am, to be honest, our growth, we are anticipated our growth for FY25 is around, in FY23, we have completed our IPO, maiden IPO, and we had pipeline of 2 new expansion, and our capacity was expanded almost all double during the FY23, and this is coming to the in force in FY24. That is why the revenue was jumped from almost all 80% comparatively to the last year. This year, anyhow, we are expecting near about 52% of growth from the comparatively to the last year. But this particular quarter is little bit soft. And after coming to the complete this quarter, we have to give the correct figure. But as of now, we are anticipated that somewhere around 50% we have to grow.
And so how is pricing evolving here in your segments?
Pricing's a little bit down at this moment. See, basically what happened every year, if you see the trajectory of the history, every year this particular second quarter was soft. Due to that monsoon season and infrastructure work is a little bit slow down in India. So therefore it will be the soft. But in the coming aspect in the third quarter, Q3 and Q4, we are expecting it's a good result, and the price will be, this is the lowest price present market scenario in the steel market, and we will be anticipated that it will be much more corrected.
Got it, Mr. Bhattacharya. And in terms of like a 1 to 2 year guidance in terms of your revenues and your volumes, where does that stand at?
If already we have disclosed in recent past August also. So basically, we are expecting that by FY26, whatever our existing capacity, installed capacity, that is gross production capacity is 0.7 million and the net output is 0.4 million. So we are expecting we will be achieving the 0.4 million. We can able to use the entire capacity in an optimum level by FY26. And therefore, we will be definitely achieve almost all whatever our earlier targeted top line, that much we can achieve. If you see that last for FY24 to FY26 top line, so it will be automatically in FY24 audited to FY26, which will be coming, it will be automatically double.
So, please continue.
Yeah, tell me. No.
Okay, so an FY26 sales guidance of around 2,500 crores. In terms of your EBITDA per ton, is there a specific target for the same?
We are expecting the EBITDA per ton in FY26 somewhere around 8,000 plus.
And in terms of, outlook for the rest of the year, in terms of pricing and your realizations in regard to the pricing, what's your view on how will pricing improve? Q2 will be soft, but do you expect a pickup in the second half?
Yeah, if you take, see, every product having different range of price. Like for an example, if you see presently GI pipe rate is coming around 70, whereas the GP pipe rate is coming around 65. And the MS pipe is somewhere around 50, present scenario I'm talking about. But on an average, our realization is coming around near to 56, 57 contribution of all the products. So like that, we are expecting the growing of this realization is almost all near to 59 to 60, which we have got in FY25, that is unprecedented 65,000. But that we are not expecting. But anyhow, we are expecting somewhere around 59 to 60 will be the correct price. And the market will be, all the corrections will be made by that time. And this is the correct price, average price realization rate will be coming into the market.
Got it. And in terms of your revenue breakup, now in FY24, we saw 37% of revenues from MS tubes, 53% from GPCR pipe and coil. Is this the mix, that optimal mix that you're targeting, or would you like one segment to have a higher share?
Mostly, if you see that, mostly we are anticipated the most contribution by GP, and that is our, what do you call it, MS pipe contributed around 29%, and the maximum contributed by GP.
So that's the optimal mix you'd like to remain at?
Yeah, 69% almost all, it will be contributed by FY26 galvanized unit. Because we have the total capacity. If you see that our total capacity, our 3 lakh tons of capacity, we are enhancing in our galvanized unit itself. Whereas our MS pipe segment and backward integration also all togetherly having 1,32,000 capacity. So therefore, automatically 70% near to 69% are coming from the galvanized unit.
Got it. And in terms of scaffolding, I know this is a segment that is, rather caters to a niche segment, but what's the kind of growth potential you're seeing from there?
See, that is constant, ma'am, because we are not going to expanding any capacity in scaffolding. Our existing capacity is 5,000, and we are almost all using the optimum level, and we are expecting 4,500 metric tons can be eligible maximum we can produce. and accordingly this top line will be consistent delivered, and the margin is also consistent.
Right, sir. Sir, this new issue in terms of fresh equity, what does this do to both your EPS or earnings per share number for FY25? Do you believe that this dilution will impact that number in a substantial way? That's one, because it's a large dilution. Second is, does it impact your return ratios in a significant fashion?
Initially it is showing like that. And if we see if you see it on today, we have to calculate in such way. But in the coming future, when you have that much of that much of fund, so your interest part will be cutting down. Your growth trajectory will be going much more faster, and we have multiple options to added our value-added product, and our in terms of margin, we have options. So therefore, once the profitability PAT will be going up, it doesn't matter how much outstanding shares are there and what is the EPS. EPS will be corrected automatically. Initial level, it is showing for the investors' point of view, if the outstanding shares is going up, so therefore if the profit will be corrected this way as assumption. So therefore the EPS will be coming down. But at the same time, we have to think in the other way. If the company is having substantial cash, so therefore the companies automatically grow multiple times, and the company is having that potentially to enhance their profitability also. Therefore, their EPS will be constant.
Right, sir. So sir, can we expect a turnaround in FY26? Just a yes or a no answer.
Sorry, can you repeat again?
EPS will bounce back above FY24 levels in FY26. Is that the right way to look at it?
EPS already we have whatever we have estimated. So that is almost all, you can say, in FY24 is somewhere around 20. So now we are expecting this, it is all and around 20, 22, 25. It's like that.
Okay, thank you so much, sir. It's been a pleasure speaking with you and breaking this down. Thank you.